Hello there. Welcome to Costing and Management Accounting, N6. Today we want to look at a question from a question paper of November 2022. This was the first question on that question paper, and we are going to go through the questions that we have here. And the first question that we have, that is question 1. We on 1.1. We are given a table, and then we will balance BD. It's a question mark, and then we've got materials 300,000, labor 650,000. So we are also given additional information whereby we have got manufacturing overheads are recovered at 60%. So this is the recovery rate, 60% of the direct labor cost. So that's the key. That is 60% of the direct labor cost. And then we have 2,500 units which were produced. And then on the first part of the question, that is 1.1.1, it reads calculate the manufacturing overheads. Right, so manufacturing overheads is the one that we want to calculate. And if you come here, this is the part that we want to calculate where we are having a question mark. But if you go back to the additional information, you would see that the hint that we are given there in terms of calculating the manufacturing overheads is that it is 60% of direct labor costs. So direct labor costs, the figure that we have is here, 650,000. So basically what it means that the manufacturing overheads figure, we're going to say 60% of this 650,000 that we have here. So we can come here and try to create some space there so that we calculate that figure. If you come here, so we are going to say this is 1.1.1 on 1.1.1. So we are going to say 60%, which is 60% is 0.6 as a decimal, and then we multiply by the 650 that we are given here. So if you multiply this one, you are supposed to get 390,000 rands. So 390,000 rands is the answer that we have there. So this one is now represents our manufacturing overheads on the first part. And it has got 3 marks. We can take note of that. Right. And the second part is saying calculate the production cost. So the production cost, basically now we are adding the materials figure here, which is 300,000, and then we add the labor that is we have, which is 650, and then also the manufacturing overheads figure that we have calculated here, 390, representing this question mark, also is part of that. So we are just going to add 390,000, and then we add the other 2. So we are now on 1.1.2. So basically we are saying 300,000. Then we add our 650, 650,000 here. And then finally we add this figure that we've calculated on the first part, that is 390,000. So calculating that, if you add that, you're supposed to get the figure that you're supposed to get is 1,340,000. So that is the figure that we have there on the second part. And then at the last part here that we are having is saying calculate the cost per unit. Calculate the cost per unit. Remember, we are given the number of units there. We can recheck, try to see the number of units that we have there. We have 2,500 units, and we found that our production cost total is 1,340,000. So basically, we are dividing this figure by 2,500 units so that we can see the cost per unit. So if you come here now, we are now on 1.1.3. We are now saying 1.1.3. So we are saying this production cost total, which is 1,340,000. Then we divide by the number of units that we are given in the question, is 2,500. Right. If you divide that one, the answer that you are supposed to get there is going to be per unit. So you are going to say 536. If you divide there, you get 536. 536 per unit. So that's the answer that we have there on the last part of the first question of the question. Right. If you go to the question here, you'd see that we are now going to 1.2. And 1.2 is only asking us about definitions of these terms that we have here. We have got certified work, retention money, contractor, contractee, and then we have got a contract. So we just need to give definitions of these terms that we have here, and we have got 2 marks for each, as indicated by the allocation of marks that we're having here, right? So we start with certified work. So certified work, basically, it represents that part of work that has already been done and are waiting to be paid. So if you come here with a summary of these explanations that we have, certified work it refers to the part of work that has already been done there on the contract. So I think there's something that is left there that has already been done here. That has already been done on the contract, and it's ready for payment. So basically, that's the explanation that we have on certified work. So it's that part of work that has been done and is already ready for payment. And remember that part of work should be certified by the architect for us to regard it as a certified work. So basically, I can repeat the definition here. It refers to the part of work that has already been done on the contract and it's ready for payment. So that's what we have on terms of certified work. Then on the second part, we've got a question that is asking us on the explanation of retention money. And this is the explanation that I have here in terms of retention money. So the explanation is reading, this is money put aside by the contractee to protect himself or herself against defective work done by the contractor. Remember, the contractee is the one who is paying for this contract. So this contractee will set aside some money to take note of if ever there is anything that is not done in line with the agreement by the contractor. The contractee can take that money to as compensation of that defective work that has been done. So defective work done, meaning work that has not been done properly according to what has been agreed, maybe done substandard, and that's what we refer to as defective work done. So that's what we have in terms of retention money. Then we move on to the next one. The next one is asking us an explanation on the contractor. Right, so this is the remember, whenever there's a contract, we have got 2 parties that are there. We have got the contractor and then we've got the contractee. And then the contractor is the one that is executing the job, and then the contractee is the one who is paying or be it the buyer of that contract. So the explanation in terms of the contractor is here. The contractor is the person or party responsible for executing the contract. So that's the explanation on the contractor. Then you go to the next one is contractee. That is 1.2.4 is saying is the person or party for whom the contract is completed. So basically, you'd see that the contractor is the one who is going to hire the contractor and award the contractor the contract, and is going to pay the contractor. So that's what we have in terms of the contractee, is the person or party for whom the contract is completed. So that's what we have there. Then lastly, we have a contract. The contract now is an agreement between the 2 parties. It's an agreement that we are going to have between the 2 parties. That is the contractor and the contractee. So I think there's a missing component there. A contract is an agreement between here is between the contractor and contractee. So that's the explanation that we have there. A contract is an agreement between the contractor and the contractee, thereby creating a legal obligation for both of them. So there should be a legal obligation that it should exist between the 2 parties, and all parties are bound. They are bound legally, of course, to perform the terms. So here, the last part is saying all the parties are bound to abide by the terms. They have to abide by the terms since it's an agreement that has been reached, and it counts also for legal obligations. So that's what we have in terms of explanations, in terms of these terms that we are given in this question. So we can move on to the next part of that question. If you go on now, we beneath that we have got 1.3. Beneath that we have got 1.3. And 1.3 reads standard labor cost per unit according to the standard cost card is 1 hour. It's 10 rand 50 per hour. Then actual hours worked are 650 hours at 15 rand 50 per hour. Then lastly, 300 units were manufactured and completed. Then first part is saying calculate the labor rate variance. Calculate the labor rate variance. So what is important there is first to put the formula for labor rate variance. So here is now 1.3.1. So labor rate variance, the formula, we can just maybe indicate it in an abbreviation that this is the labor rate variance. It is equal to standard rate minus actual rate. Then in brackets, then we multiply by actual rate. So here we multiply by actual rate out of the brackets, right? So we go back to the question to try to find out what do we have in terms of standard rate there. What we have in terms of standard rates, we can go up to try to find out. Right, on the first part of the question is saying standard labor cost per unit according to the standard cost card is 1 hour at 10 rand 50. So 10 rand 50 becomes the standard rate, and then here we are saying 10 rand 50. 10 rand 50 here representing standard rate. Then we subtract actual rate. Then the actual rate, now we come here, we're saying actual hours worked are 650 hours at 15 rand 50. So this one becomes the actual rate. So we are now saying minus 15.50. And then the actual time, we are not given it there as we are seeing the actual time. We can try to find out, right? The actual time we are given it there is here 650 hours. So 650 hours there. Then we multiply it here out of the brackets. Then we try to calculate that calculation. If you calculate there, let's try to calculate there so that we find what you're supposed to get there, right? If you calculate, you'd see that here, if you subtract here, you're going to get 5. And then obviously, multiply by 650. Multiply by 650. And obviously, when you multiply the two, you're supposed to get 3,250. Right. So having got this answer, you are supposed to indicate whether it's favorable or unfavorable. So for you to see whether it's favorable or unfavorable, you'd see that if standard in brackets here, if standard is less than actual, if standard is less than actual, it represents an unfavorable position. But if standard is greater than actual, you'd see that it represents a favorable. So in this instance, if you look in the brackets, you'd see that standard there is 1050, then actual is 1550. So standard is less. So we are here, standard less than actual, so it's unfavorable. So here we are saying unfavorable. So that's what we have in terms of the first part of labor rate variance. Then we go to the second part, which is calculate the labor efficiency variance. The labor efficiency variance, obviously, again, we are supposed to come up with the formula for labor efficiency variance. So this is the second part, which is 1.3.2. So we are now on 1.3.2. This is now efficiency. Efficiency variance. And the formula for efficiency variance is standard time minus actual time. And then the answer that we are supposed to get there, then you multiply by standard rate. Then you'd see that standard time, let's try to start by finding the standard time from the question. Right, for standard time, we are saying our standard time here, let's try to see there. Right, our standard time, we are given it from the first sentence there. Standard labor cost per unit according to the standard cost card is 1 hour. So it means 1 unit is referring to 1 hour. 1 unit is referring to 1 hour. I think it's indicated here if you try to look at it per unit and then representing 1 hour. So what it means, we have 1 unit representing 1 hour, and the units total number of units that are there, we have got 300 units. So it means 1 times 300, we are going to get 300 hours, and 300 hours will represent our standard time. So standard time, we have got 300 hours. Then actual time now, you'll see that actual is we are given here. Actual hours worked are 650 here. So this is our actual. So we are just going to say 300 minus 650 in our brackets. So we go back there. 300 minus 650 here there. So equals to 300 minus 650. And obviously the standard rate now, the standard rate, we go back to confirm again. You see that the standard rate, we are given it here, is 1050. This one, standard labor cost per unit according to the standard cost card is 1 hour at 10 rand 50 per hour. So this one, 10 rand 50 per hour, is our standard rate. So we come here again, we substitute that one is 10 rand 50. So when you multiply that one, 300 minus 650, then the answer that you get, you multiply by 1050. Obviously, there when you subtract, you're going to get 350. Then you multiply by 1050. There, then you get 3,675. And then obviously we need to identify whether it's favorable and unfavorable. Remember, we said standard. You remember we said if the standard is less than actual, yeah, standard less than actual, it gives us an unfavorable. So this one also will represent unfavorable. Unfavorable. So this is what we have in terms of 1.3.2. So obviously now we go to the next question. Next question is 1.4. Is saying we are given a table there where we've got a column for months and then total sales. And then additional information is saying 45% of sales are on credit. So what does it mean? It means 100 minus 45 will give us the cash sales. If 45% is on credit, say 100 minus 45, then we are going to get 55 there. So 55% is representing our cash sales. So this is our cash sales. Right, that's what we have there. Then we have got credit sales are collected as follows. So out of this 45% which are on credit, this is how they are going to be collected. 30% in the month of sale. So in that very month that we are going to sell the credit sales, we are going to collect 30% of the whole is a collection. Then 50% 30 days after the month of sale, which means after 1 month we collect 50%. Then 15% will be 60 days, which is 2 months after the month of sale. Then the remaining credit is bad debt. The remaining credit is bad debt. So what does it mean? So the component of bad debt there, we can calculate it. you can just say 100 minus 30 plus 50 plus 50. So if you calculate that one, you see that this is 95 that we have here. Then subtract there, we get 5%. So this one is representing our bad debt. So the last part of the question, that is question is saying calculate the bad debts for January, February, March, April, and May. The bad debts. So there, what we can do there, we can just simply maybe try to add a column there so that we calculate the bad debt component. There now we are saying here. This is now bad debt. Bad debt. There we can create a column there. So what we are going to do there is that we are given total sales there. We are given total sales there in the table that we are given in the question. We are given total sales as a column there. So out of the total sales, 45% of them are on credit. So what we are going to do, we are going to say 45%, for example, for January, say 45% of 15,000. Then we get the whole component of credit sales. Then from that 45%, we know that 5% of that figure is going to be bad debt according to the calculation that we made there. Then we say 5% of the answer that we are going to get. So we are going to start with January. Let's create their space for so that we do, and then we say January. For January, we are going to say 15,000 that we have there. We multiply by 45%, which is 0.45. We multiply by 45%. Right, if you multiply by 45% there, we say 45%, which is 0.45. Then we multiply by 15,000 for January. Then if you multiply the two, let's try to calculate that one. Then obviously, when you multiply that one, the answer that you are supposed to get there, you multiply it again by 0.05, which is the component of bad debt now. This is the component of credit. And then after getting the component of credit, then you multiply by 0.05, which is indicating bad debts. Then if you calculate that one, if you calculate that one, you are supposed to get 337.50. So this is what we have for January. Then we go to February. Now we are on February. Right, for February now we are saying again 0.45 component of credit. Then we multiply by the total sales that we have there, that is 25,000. 25,000. Then also we multiply by 0.05 to get the component of bad debt. So when you multiply that one, you are supposed to get 562. 562 rands 50. That's what we have on February. Then for March, we are supposed to use this figure, which is 35,000. For March, we are using 35,000. For March, we are using 35,000. Right, so now we are now in March, and March is here. We are using 35,000. So we are using 35,000. So we come here, we say 0.45. We multiply by the figure that we have for March, which is 35,000. And obviously, the answer now we multiply by 0.05, which is the component for bad debt. So if you calculate that one, for March, we are supposed to get 787,000. 787.50. 787 rand. Then if we have a 0.50 there, 50 cents there. So that's what we have in terms of March. Then from 35,000, we are going to the next one, which is April. April is here, which is 45,000. So we can put that one again for April. 45,000. Now we are on April. In April, we are saying it's 45,000. So we are saying 0.45. We multiply by 45,000. Then the answer that we get, we multiply by 0.05. Then the answer that we get, we multiply by 0.05. Then we get 1,012.50. That is what we have for April. Then from April, we go to May. Then we check the figure that we have for May for total sales. We are seeing for May, we have got 55,000 here. So we are going to use 55,000 there again. So we are now saying the last one, which is May. So we are saying 0.45. Then we multiply by the figure that we are giving for May, which is 55,000. Then we multiply by 0.05. Right, so if we multiply that one, we get 1,237.50. 1,237.50. So that's what we have in terms of the table that we are given there in terms of the calculation of the component of a bed debt. Having done that, we can move on to the next part of the question. Let's try to see what we have next. Right. So that's what we have here. We are now going to 1.5, which we are given a table, fixed costs, 35,000. So this is representing the total fixed cost that we are having on that part of the question, which is 35,000. And then we also have variable cost. Variable cost, we're given per unit, which is 15 rand per unit. Then selling price is 65 rand per unit. Then estimated units produced and sold, we have got 300 units. Then the first part of the question is saying calculate the total variable cost. Calculate the total variable cost. So calculation of the total now, total variable cost there. We are saying estimated units produced and sold. We have got 300 units that has been produced and sold, and we know that each variable cost per unit, we have got 15 rand per unit. So we are going to multiply 300 multiply by 15 to get the total variable cost. So if you come here now, this is 1.5.1. 1.5.1, we are saying total variable cost is equal to the total number of units you multiply by the amount per unit. So you put 300, then you multiply by 50. And if you multiply the two, you are supposed to get 4,500. So that's what we have there. Then we move on to the next one, which is 1.5.2. 1.5.2, we go back to see what 1.5.2 is requiring us to calculate. This one is saying calculate the total cost. Calculate the total cost, and we know that total cost is equals to variable costs plus fixed costs. And our fixed cost we are given is 35,000, and then the variable cost is the one that we calculated there. We can just edit. So we come here. We say total cost. Total cost is equals to variable cost plus fixed cost, which is equal to our variable is the one that we are given here, 4,500. Then we add the fixed that we are given in the question is 35,000. So if you add the two, you're supposed to get 39,500. So that's what we have there on 1.5.2. Then we move on to the next one, 1.5.3. On 1.5.3, we go back again to check what does it require us to prepare. It requires us to prepare the total marginal cost. Total marginal cost. Let's try to, so we have to first put the formula. So marginal cost is equals to sales minus variable cost. So this is the formula that we're going to use for this one. And then we know that fixed the variable cost, we have it, we calculated it we got 4,500 here. 4,500 here, that's the variable cost. And then the figure that we want to find is for sales. So we come back here to find out what we have for sales. Sales, we are given a selling price per unit, which is 65. And then the estimated units produced and sold, we have got 300. So we are going to say 300 times 65 to get the sales figure. So we come back here, we say 300 times 65 in brackets. Then we subtract the variable cost, remember it's 4,500. Right. Obviously, there you try to simplify it by multiplying 300 times 65. 300 times 60 times 65, you get 19,500. Let me subtract 4,500. Then you get 15,000. So that's what we have in terms of marginal cost. Then we check the next question that we have in the question. We are having recalculate the total cost of if 400 units were produced and sold. So basically, we are just substituting 300. Remember, we had 300 previously, so now we have 450. So we are just substituting on the number of units with 450. So the one total costs, and remember, total costs, we said we find it here by saying variable cost plus fixed cost. But fixed costs do not change with the level of units or number of units. We are going to have the same number, the same amount of fixed cost, which is 35,000. What is only going to change is the variable, because variable cost changes with the level of production. So if the production is increased from 300 to 450, it means our variable is going to change, but fixed won't change. So for our variable, we are now saying 450 times the variable cost per unit, which is 15. So that's what we have there. Then we add 35,000. So that's what we have there. So so we are now on the next one, is 1.5.4. So we are saying total cost is equals to variable cost plus fixed cost. And then we know that our variable now we are saying 450 times 50. And then we add our fixed cost. Remember, it's not changing, it's 35,000. Right. If you do that, there, try to calculate that. You're supposed to get here, if you simplify it, 450 times 15, you get 6,750. And then you add your 35,000 for fixed costs. There, if you add the two, you're supposed to get 41,750. So that's what we have in terms of 1.5.4, which is the end of the question one that we want to look at in this video. So basically, that's what we have, guys, in terms of cost and management accounting N6. This is a question from November 2022. Stay tuned for more videos as we prepare for exams. I wish you good luck. Those of you who have subscribed, please subscribe and share. We'll meet again in the next video. With that, I'm signing out.